Hi everyone, it's your daily 10-minute business and finance news wrap for this Wednesday, the 27th of July 2022. The headline inflation rate has come in at a 21-year high of 6.1% for the year, placing further pressure on the Reserve Bank to continue lifting interest rates aggressively. For more, I spoke earlier with economist Saul Eslake. Saul, how would you describe the current inflationary environment in Australia?
Well, it's worrying and concerning. Today's figures show that inflation is running at its highest level since 1990, which of course was the last time the Reserve Bank felt it necessary to push interest rates up to levels that induced a recession in order to, in Paul Keating's famous phrase, snap the inflation stick. It's to be very much hoped we don't have the same outcome this time, but clearly the Reserve Bank will need to raise interest rates some more in order to ensure that after peaking later this year, inflation does fall over the following 12 to 18 months back into its 2 to 3% target range.
That's the interesting thing, right? So that annual inflation rate is at 6.1%. I think a few weeks or months ago, the Reserve Bank already said, hey, we expect inflation to reach 7%. We'll talk about that in a few more moments. But where is most of this price pressure coming from that we saw in the report today?
Well, in the June quarter, as in the March quarter, though not quite to the same extent, more than half the inflation is coming from just two sources. Higher petrol prices, which is obviously global in nature. It reflects the increases in crude oil prices over this period, dampened a little by the previous government's reduction in fuel excise. And secondly, it comes from an increase of more than 30% over the last year. An increase of more than 20% over the last year in new dwelling construction costs, which has a global element to it, but also, of course, reflects the inflation of the demand for new housing by the combination of very generous first home owner grants and very low interest rates. But having said that, those two factors account for more than half the increase in inflation in the last two quarters. Nonetheless, it's also clear from the last two quarters' numbers that inflation has become more broadly based. There are 90 different expenditure subclasses, as the ABS calls them, in the CPI. And whereas over the decade to the end of last year, typically about 35 of those 90 would show falls in prices each quarter and about 55 show increases, in the last two quarters, fewer than 15 items in the CPI have shown price declines, whilst more than 70 of the items in the CPI have shown price increases. And in the last two quarters, more than 20 items have shown price increases of more than 3% in the past two quarters. So inflation's certainly becoming more broadly based, and that's why it can't be dismissed as solely due to things that are beyond the Reserve Bank's control.
But at the same time, isn't the consumer still spending? I mean, yesterday, for example, Myer was saying that sales are up and numbers are going to be better than expecting. So how does the consumer feel? And do rate rises and higher inflation take a bit of time to flow through to the consumer? Because I know we're already seeing property prices, for example, start to ease.
Well, yes, consumer demand does appear still to be very strong. We'll get an update tomorrow on how strong retail sales were in June, but we know they rose as much in May, when the first increase in interest rates took place, as they did in April. And we also know that the biggest contributor to the increase in consumer spending in May was spending at department stores, which is largely discretionary. Households do have, in aggregate, a very large volume of pent-up savings accumulated since the onset of COVID, which they're clearly drawing down in order to sustain their spending in the face of higher prices and now higher interest rates. And while no doubt households at the bottom end of the income distribution on pensions and benefits and on low wages are experiencing, in some cases, considerable difficulty, it would seem the majority of Australian households are so far able to cope fairly well. They will have been reinforced during the current month by another round of personal income tax cuts. And although interest rates have gone up a lot over the last 3 months, by historical standards, they're still very low. They're negative in real terms, and that's why the Reserve Bank's now in a hurry to put interest rates back to a level that's more appropriate for an economy with unemployment at 3.5%, the 48-year low, and inflation at 6%, a 30-year high.
So just how much of a hurry is the Reserve Bank in to lift interest rates? What are you expecting it to now do next week? And does it change where you think the peak in interest rates is going to be?
I don't think there's anything in today's numbers that would warrant the Reserve Bank raising rates by 75 basis points at next Tuesday's board meeting, as some have speculated, although the US Federal Reserve will probably raise their rates by 75 basis points overnight, our time. Their inflation rate is 3 percentage points higher than ours, and their board doesn't meet as often as ours does. So if they want to get rates up to a particular level, they have to raise them more at each meeting than our Reserve Bank board needs to do. I would think the Reserve Bank is still likely to want to get the cash rate up to about 2.5% by the end of this year, which implies if they do 50 next week, that they'll need to do 25 basis points or thereabouts at each of the remaining 4 meetings in 2022. And they may well raise the cash rate further to somewhere closer to 3% in the early months of 2023, unless they see earlier evidence that inflation is starting to fall around the world. That's a possibility, but it's not one that I would be banking on at this stage.
And finally, what do you think are the risks associated with having rising inflation and rising rates?
Well, the risk clearly is, as the IMF warned overnight, that central banks take rates up further than proves necessary to bring inflation down, and in so doing unintentionally tips the economy into recession. That's happened, although not much in the last 20 years, is certainly what happened in Australia at the end of the 1980s and the beginning of the 1990s, and that's not something we want to see repeated now.
And finally, with inflation at 6.1%, you've mentioned how the consumer has got a lot of savings to draw on. Interest rates are rising, but still relatively low. To what extent is the consumer being impacted? I mean, we hear a lot about the rising cost of living. Is it really that tough for them?
It's certainly tough for those who are on very low wages or who are on pensions and benefits, where past increases in wages or in lagged indexed pensions and benefits aren't fully compensating for the price increases, especially for essential items that have risen more in price than discretionary items. And people on low incomes spend a bigger proportion of their low incomes on essential items than more affluent households. So I don't doubt for a moment that people in the bottom half of the income distribution really are feeling a pinch from rising prices, and if they have mortgages as well, then from rising interest rates too. But in aggregate, Australian households are, as the Deputy Governor of the Reserve Bank said last week, on the whole reasonably well placed to cope with the sort of increases in interest rates that financial markets are now pricing. There are households who will be adversely affected by further increases in variable rates, and those who've come off very low fixed rates when their fixed rate mortgages expire will face potentially significantly higher increases in their repayments. But each of those groups, though they're not trivially small, don't account for a majority of Australian households.